the risk that we see for fiat currencies as foreigners and increasingly domestic institutions begin to latch on to what actually drives interest rates, and that is the risk of an investment and the currency it's denominated in. And they see those risks rising. This is not going to be good. So that, I'm afraid, is the outlook. And it's very good for gold in the sense that gold prices will appear to rise and rise and rise. But of course, it's not so much gold rising, it's the value of what you measure it in collapsing. And I think that we're seeing this beginning to accelerate. And this has become a lot more obvious in recent days.
Veteran economist Alasdair Macleod believes that if the broader macroeconomic trend continues, where precious metals regain value relative to fiat currencies, silver could see a dramatic surge, not only in dollar terms, but even outpacing gold. He argues this shift signals a deeper repricing of tangible assets, as trust in fiat currencies steadily erodes on a global scale. While the official U.S. national debt stands at $36.22 trillion, many analysts warn that the true fiscal position is far worse. When accounting for unfunded liabilities like Social Security, Medicare, and other long-term entitlements, total obligations are estimated to exceed $100 trillion. Rick Rule of Rule Investment Media highlights the consequences of such an unsustainable debt load, stating, "We will have to allow the purchasing power of the US dollar to decline so that we can honor our nominal debts while not honoring our real debts." He predicts that the dollar could lose up to 75% of its purchasing power over the next decade. Macleod builds on this by noting that the decline in fiat value has not only rendered silver undervalued, but has also distorted the pricing of base and industrial metals across the board. He argues the market is failing to recognize that while nominal prices may rise, they do so against a backdrop of depreciating currency, masking the real intrinsic value of physical commodities. Since February, speculation has grown that the U.S. may be considering a revaluation or even remonetization of its gold reserves. If such a move materializes, Macleod suggests metals, especially silver and base metals, could reprice dramatically, potentially rising fourfold relative to gold, as markets attempt to restore historical balance and real value in a weakening currency environment. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
It's a function, really, of the fiat currency regime that really has been in place ever since 1933-34. When gold, in early 1934, the dollar was devalued by 40%. In other words, the gold exchange rate was raised to $35 from 20.67. That sort of held all the way through to 1970, when finally the expansion of the monetary base, if you like, the expansion of unproductive dollar debt really meant that the relationship at $35 became virtually impossible to maintain. And bear in mind also that the Americans had reduced their holdings of gold from, I think, something like 22,000 tons, down to 9,000 tons in 1971, when finally they threw in the towel on the gold standard, or what sort of passed for a gold standard. And since then, we've had a fiat currency. It started off with the US Treasury going on a propaganda campaign saying, gold is no longer the standard. We went from a fixed exchange rate regime to a floating exchange rate regime. The dollar was the king currency. Okay. And it sort of got to the point where, this rubbish, this propaganda was so believed that they were even describing gold as a pet rock. It's no longer part of the system. The interesting thing is that now nobody's talking about gold at all. We just don't want to talk about it. We don't want to talk about it. But as I say, you can go back to the Emperor Diocletian, who introduced an edict of maximum prices. That was around about 270 odd or 300 AD. A long time ago. And you can look at those prices. Okay, the slave markets no longer operate, so there's no comparison there. But you look at things like, beer, wine, clothes, all these things, they're similar price today, measured in gold. The thing that's changed, of course, is that currencies come and go. And every one that comes goes. Because what's currency is credit. And eventually, the credit becomes worthless. or it becomes questioned and it has to die. That's what happens. Governments, and the Americans have been no different at all from all governments in history. Basically, what they've done is they have printed, they have expanded credit unproductively to finance whatever the politicians want or whatever the people demand of their politicians, to the point where they destroy their own currencies. And that's where we've got to. It's exactly where we've got to. It's the end of the fiat currency regime looming. How long it'll take, I don't know. I mean, it could be anything from a sudden nasty shock later on this year, or it could take another 2 or 3 years. Yes, I think we're going to see it fall further. I think we'll see it fall quite significantly. I mean, I wouldn't rule out at all. In fact, I would expect it to move back down to around about 50, which has been some sort of average over, really since about 1900, I suppose, or the 1880s. Because it was in the 1870s when silver was no longer, the silver standards, if you like, no longer applied in Europe. The last one being Germany, which went on to a gold standard, I think, in 1873, thereabouts. That meant that the value of silver was then being priced for its next use. And so the gold-silver ratio from that point rose from, 15, 16, whatever, on the way up. And, of course, it peaked under President Trump in his first term in office at something like 120. And is now on its way back down again. And this is particularly important because if I'm right about the relationship between gold and precious metals, then we are going to see silver recover very substantially, and not the only one, even measured in gold. Of course, everybody concentrates on silver because that is if you like, the second most important monetary metal in the absence of fiat currencies. So, you get loads and loads of bulls, if you like. So, pessimists like me thinking, if we're going to have a currency crisis, or it's the end of the fiat currency era, then silver's going to come back. I think that will probably fuel some speculation, but I think the main point which everybody is missing is that it's not just silver, but it is all the other base metals which have been suppressed by the fall in the purchasing power of fiat currencies. So much so, they can even quadruple against gold just to return to normality. And what does that mean if gold continues to rise against the dollar? In other words, the dollar continues to fall, pushing gold-dollar values even higher. Well, it means that when it comes to inflation inputs, if you want to look at it in more conventional economic terms, those inflation inputs are going to be very destructive of fiat currencies, horribly so. That's the future, I'm afraid. And what does that mean for bond yields? Well, up, 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 up. And it's got nothing to do with the collapse in economic activity that will happen. That's going to happen partly because of the adjustment, but also because of the past history of suppressing interest rates and the accumulation of unproductive debt.
The US dollar is steadily losing ground as it faces a persistent and compounding decline in global influence. Once the unchallenged cornerstone of international finance, the dollar is now being increasingly set aside, burdened by rising geopolitical tensions, diminishing trust, and backlash against its use as a tool of economic coercion. Former President Donald Trump's tariff-heavy policies and the global momentum toward de-dollarization have only accelerated this trend, placing the currency in what many analysts see as a long-term structural decline. Countries around the world are actively moving away from the dollar in favor of their own currencies or regional alternatives, signaling a shift toward a more multipolar monetary landscape. This shift is no longer speculative. It is becoming embedded in central bank strategies and monetary policies. The confidence that once underpinned the dollar's supremacy is weakening as nations increasingly seek to shield themselves from the financial and political risks that come with using a currency vulnerable to unilateral sanctions. Economist Alasdair Macleod emphasizes that as the purchasing power of the dollar erodes, the pricing of real assets becomes increasingly distorted. While gold has moved higher in nominal dollar terms, most base and industrial metals have lagged behind, suggesting that the weakening currency is masking the real value of these physical commodities. When fiat currencies lose strength, it's not that assets are necessarily becoming more expensive, but rather that the yardstick used to measure them, the dollar, is becoming weaker. As the global financial system adapts to this reality, tangible assets, such as precious and industrial metals, are likely to play a significantly larger role in preserving value. Let's get back to the interview.
When you look at the paper markets, of course, we really don't have all the information to be able to put all the pieces together. But I think what happened earlier this year is it raises some very, very important questions. We had suddenly, out of nowhere, huge premiums on gold and silver contracts on COMEX. And this encouraged a flood of bullion out of other centers into America. Now, the trigger for this was probably, and I think this is true, the fear that President Trump was going to have a blanket 25% tariff on all imports, including gold and silver. I would have dismissed that personally, but you can see from the point of view of American operators on COMEX that this was a problem. Why is it a problem? Well, the problem basically is they had stand for delivery obligations which were continuing at pace. I mean, it's just remarkable that this market, which was only has a stand for delivery option in order to tie the expiring value of a contract with bullion so that the whole thing is tied to bullion, if you like. The whole of the sort of series of contracts are all tied to bullion. It was never intended that this is a means whereby people would go in and acquire bullion. The fact that they're going in there and they're acquiring bullion in huge quantities tells us that there's something very, very far wrong. And that far wrong is that there is not enough supply of bullion around the world for people to really get the bullion they need. Now, we don't know who these stand for delivery are, but they're not the hedge funds in the managed money category. That we can be pretty certain, because hedge funds just have leverage plays, sell dollar, buy gold, sell gold, buy dollar. That's, there's twin trade, it's pairs trading, if you like. These are in the, the others categories, the two others categories. If you look at stands for delivery between 2021 and 2024, it's 2,100 tons. This is a very significant amount. If, on the other hand, you look at it from the beginning of this year to date, the annual rate of the stand for deliveries is roughly running close to 1,500 tons. In other words, we've gone from 2,100 over 4 years to perhaps 3,000 tons this year. No, not 3,000, sorry, 2,000 tons this year, or sort of 1,500 tons this year, 1,500 to 1,000. So in other words, the pace of the stands for deliveries has increased very, very substantially. Now, if you're operating on COMEX, you understand that you've got these obligations. There will be undelivered obligations, perhaps, insofar as, they haven't gone off your books. You've just sort of promised to deliver it and, delayed, maybe, which apparently is a feature. And also in the case of silver, in particular, the ownership of stands for delivery silver, that's still remaining mainly in the COMEX warehouses. And I guess the reason for that is that when it comes to using silver, you'll take it out as you need it. You don't necessarily think I need to actually possess this, which you would with gold. So that, I think, is what it's about. But this has created a problem because in order to take the arbitrage created by the premiums on COMEX, let's say a London operator has to take gold out of London, ship it over to New York, and then at some stage they've got to reverse the transaction, particularly if they've leased that gold. And that gold's got to be restored to whoever leased it to the bullion bank in the first place. Now, the lessors rather, are in the main central banks who've stored their gold in London and possibly, maybe to a lesser extent in Paris, maybe, Switzerland as well. But basically, we saw the rush, if you like, of gold being taken out of the Bank of England, which confirms to me that a lot of that gold was leased gold and therefore temporarily the property of, say, a bullion bank or a large fund, sort of dealing in gold and taking advantage of the arbitrage opportunity. I've got to get it back. What do the central banks in this think? They must think, hold on a minute, it's all very well earning a few pounds or dollars or euros, if you like, on leasing fees in order to pay the storage costs. But if we don't get our stuff back, our property back at the lease expiry, then we have a problem. And I think that this is the problem. We've seen one side of the transaction of the arbitrage. We haven't seen the other side yet. And that, I think, is going to, it could close down the derivatives markets. And if that happens, you've got to bear in mind that the counterparties in the precious metals derivative markets are also counterparties in other derivative markets. So the whole of this derivative thing we could start to see unwinding. And that is a very, very serious issue. There has been a lot of suppression of metals prices by virtue of the fact that the dollar has been debased. That the dollar is the principal currency. All the other currencies go with it, but the dollar has been debased so much that they've also taken down the value of base metals. But my starting point in trying to explain this is that we know that over long periods of time, the purchasing power of gold is relatively constant. Now, obviously, individual commodities, some will rise and some will fall. There will be differences, if you like, because of in demand and also supply, new mines and mines being exhausted and, fashion, or if you like, new technology moving on into other materials. So you'll get all this sort of evolution, if you like, going on. But if you take a sort of a basket of base metals, then quite obviously there is a level where those base metals will be priced in gold relatively constantly over time. Now, there can be some variation of that. I mean, in wars, for example.
Underneath the steady hum of economic data lies a quieter but more profound transition, one in which the unit of measure is being questioned more than the measured. As the global monetary consensus fractures, nations are retreating from dependence to sovereignty, recalibrating their reserves and trade around assets that cannot be printed at will. This shift isn't just monetary, it's philosophical, where value must now be rooted in scarcity, not promises. As a result, metals long dismissed as industrial inputs or speculative plays are being reevaluated as strategic anchors in a multipolar economy. What appears as volatility in commodity markets may be the early tremors of a broader repricing of trust itself. Is the world approaching a threshold where the erosion of currency confidence forces a reset, one where metal regains its voice as money, and nations no longer measure wealth in dollars, but in durability? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.